Good morning again, everybody, and thanks for staying here to enjoy, I think, some interesting comments and light relief from our panelists. And I'll take a second or two just to identify what we'll cover in the course of the next 50 minutes or so. So again, I think it's worthwhile reflecting, and this has been mentioned in the speeches before, that the committees are very much the heartbeat of ICMA, both in informing and driving the breadth of both our regulatory advocacy work and also the market best practice priorities that we engage with the membership on a consistent basis. And clearly the chairs of the committees are absolutely at the center and instrumental in everything that we do. And on that basis, it gives me great pleasure to be joined here by 6 chairs of some of our most influential, I think it's fair to say, committees to talk about their work and their achievements in the course of the last year. I think this panel is something of a tradition as well at ICMA to kick the conference proceedings off. So I think we're all looking forward to hear your reflections. By way of very, very quick introduction, I'm joined by Gareth Allen, who's the chair of the European Repo and Collateral Council, David Camara, who is the chair of the Secondary Market Practices Committee, Stéphane Janin, the co-chair of the Asset Management and Investors Council, Isabelle Laurent, the chair of the Principals Executive Committee, Marc Lewell, the co-chair of the Primary Market Practices Committee, and Emma Lovett, who is the chair of the Fintech Advisory Committee. So the co-chair, Emma, is it? I think it's the co-chair, yeah. Thank you. Maybe just kind of moving first from my direct left and opening with you, Gareth. I guess the ERCC has just celebrated its 25th anniversary. I think it is extremely well established as the industry authority in European repo and collateral matters. So I think it's very apt to perhaps start with some comments from you. I think we'd be interested to hear, and I'll go through all of the panelists with sort of the first topic, which is maybe just to refresh the purpose, the scope and membership of your committee, how you've been functioning in the course of the last 12 months. And I think also maybe it'd be helpful to reference 1 or 2 major initiatives or key areas of major importance which has been undertaken or is in train from the group in the course of the last year.
Yep, sure. Thanks, Bryan. As you said, right, this committee was formed 1999, 25 years ago, a quarter of a century. We recently celebrated this in London with a huge gala dinner, which was hugely well received and enjoyed by everyone, bringing kind of old committee members of ICMA together, even people who'd retired for many years, which was absolutely a fantastic event. So the ERCC, so what do? We bring together SMEs across the repo and collateral markets. It's buy side, sell side, and infrastructure. So we make kind of a large emphasis in the last few years in making it as wide and inclusive as possible. Just to recognize that the financial markets, it's not just the banks, it's much more than that. There are over 100 member firms to the ERCC. So if you're not a member of the ERCC and you're part of the ICMA wider membership and you're involved in the repo, collateral or funding markets, then please get in touch with the ICMA about joining the repo and collateral space. The committee itself is made up of 19 representatives elected every year, typically meeting 4 to 5 times a year for like a whole afternoon, normally a very, very packed agenda covering many topics. So just to recap the current scope and purpose, so we talk a lot about best practice. We have the best practice guide for repo and collateral, so if an issue comes up in the market or something that needs clarifying, many times members will come to the committee and ask for clarification. It'll be discussed and then agreed on a consensus, and then normally written into and updated into the guide itself. The ongoing input into the GMRA, the Global Master Repurchase Agreement, is the market standard for repo agreements across the globe. always changing. I think mentioned earlier was the digital annex, which is hopefully soon to be published, just to again keep moving with the times. We have many discussions with regulators, central banks about the market and implementation of regulation or clarification around parts of regulations. There are many working groups as well, so I'd like to say thank you to everyone who's involved in the many working groups involved with the committee. Just to name a few, we have a prudential working group, there's an operations working group, there's the best practice, there's an SFTR task force which has hundreds and hundreds of members involved in how this works. There's the Repo legal working group, which again gets into the nitty-gritty of the various issues, and we have the Repo and sustainability task force. And then I guess maybe just to touch on a couple of the key agenda topics that we've been discussing over the last year and onwards through the next year. So we have things like settlement efficiency, T+1. It's very timely topic as this comes to market. So the potential impact here to settlement efficiency and also intraday. Because remember, it's T+1 for the cash markets, but for the repo markets, that pushes us into the T0 space. That's same-day settlement. You've got client clearing for repo, very hot topic with the move to mandatory clearing in the US. Prudential regulation, NSFR, and the treatment of repo and updates. Lots of buy-side issues get discussed. Market transparency, we're talking about all the time. We have the repo reports and surveys every year. And then just to highlight one key initiative over the past sort of 12 months we think has been quite a success, was clarity from some of the European authorities on the liquidity treatment of open trades, where open repo transactions, there's a legal right to terminate these to create an inflow in your liquidity metrics. So that's a culmination of many meetings with various participants just to discuss and explain the technicals of how this works. And the result was a clarification in the Q&A for Europe that banks can agree with their regulators the circumstances in which you can generate an inflow. So hopefully that gives you a flavor for what we're up to.
Thanks, Gareth, and I think I would certainly, echo your comments on the dinner in London to celebrate the 25th anniversary of the ERCC. I think it's a part of the industry that is populated by some great characters, and that was very clear in the course of that gathering. I think it's a very sort of close community as well, actually. Which I
wonder is Godfried here, and is he wearing his dinosaur hat? That's
yeah. If we can get Godfried's dinosaur hat, I think that would be a worthwhile addition to the panel. So, David, maybe moving on to you. SMPC is arguably one of our sort of, if not the largest, the broadest and largest committee, I would say, that we have in terms of the reach and the involvement from the different kinds of members. Maybe you can, add to Gareth's points from a specific angle of the secondary market activities.
Yeah, thanks, Bryan, and buenos dias. I hope you're all well awake by now. First of all, thanks for inviting me to describe the year activity of our committee. I'm very jealous of your dinner, by the way, Gareth, so maybe this year we'll have something on our side. So jokes apart, it was a year in markets, right? I think I will describe it in two ways. The first way was I was learning a lot of English with adjectives to describe inflation this year. I think it was the year to chase the next word for inflation. And actually trading happened very much according to that adjective. If it was stubborn, if it was flat, if it was going down, up. Like I learned a lot of new words, and markets and market floors reacted very much depending on that. That's one element. And the other element of the year has been, well, quite unfortunate geopolitical situation in which, I think a lot of us came to the office a few days holding our breath thinking, now it's happening. But it didn't happen. And the markets were pretty resilient despite some spikes of volatility, but they were pretty resilient this year. They continued to trade despite the horrendous things happening in the world. And that's quite remarkable. It shows a lot of strength, and it shows that they're interconnected and global. Going back to our committee, it is an open committee for ICMA members, buy side, sell side, infrastructures. We discuss bond trading, and we try to do it in a lively manner. Really thankful to Andy and Nina for their preparation and thoughtful leadership here as well. It has been the year of MiFID 2 or 3 or I don't know, whichever now, reform. We've been talking about transparency. We have been talking about T+1. There has been less component of electronic trading and fintech this year, but we're ready to bring it up again, given that it's 50% of the volume we trade now is electronic in bonds, and roughly 85% of the trades. There's a lot of electronic and algorithmic trading going on, new entrants. It's a very interesting landscape. I would say that maybe the one highlight of the year was when FINRA trade. So we had a lot of speakers. We had Bank of England, the European Commission talking about European EU issuance. And the highlight of the year was probably when we had FINRA trades in the room talking about the consolidated tape. And I think a few of us thought, well, how can we complicate our things so much in Europe if FINRA trades got it? It took years, but it was one tape, right? If you think about Europe, there's a bit of a contradiction with multiple consolidated tapes in itself. It's contradictory. So having FINRA in the room raised a lot of eyebrows and had us think a lot. Transparency work has been the highlight. The comments about, ESMA consultation paper just released with the tables that are very much in line with what ICMA has been suggesting, and I think that was the key highlight. So I'll wrap it up there. We'll talk later about challenges.
Thanks, David. Very interesting here, as you say, and I think the work that's been done, on market resilience is actually a very good segue into introducing Stéphane into the discussion, because I think the two committees have worked closely to support the work that we've been doing on market resilience and depth and liquidity and the report that was published. So, Stéphane, I think this year in particular, we're probably going to see AMEC become a very active and important committee as part of ICMA's work when you reflect on the launch of the Commission on the consultation, what we've seen from FSB and IOSCO on the need to perhaps shine a more of a regulatory light on the broader buy-side contingents as we look ahead. But maybe you can reflect in a couple of minutes on the committee that we have and what you've seen the successes in the past year and obviously what we have to do as we get further into this.
Yeah, good morning, everyone. Definitely what I think is what is making ICMA unique in a way is the fact it is both a sell-side and buy-side association. And the committee I represent this morning is a purely dedicated buy-side committee named Asset Management and Investors Council, which both interacts with other committees in many ways, but has also its own dedicated committee, which I co-chair. And so the aim of this buy-side committee is, so number one, who is a member of it? Obviously asset managers, but not only asset managers, also asset owners and pension funds to bring together various views from the buy-side perspective. And what are the topics are of two kinds, like other committees, which are mixed between sell-side and buy-side, which are basically market practices and policy evolutions or developments. So what is our way of functioning? We have quarterly in-person meetings or hybrid meetings in which we bring guest speakers or guests as such, either from central banks to bring some economic views or financial views, as well as regulators or supervisors. And during the last 12 months, during those quarterly meetings, we had very important guests, as like the Secretary General of IOSCO, the International Organization of Securities Commission. When we set the meeting in Madrid, where IOSCO was, we thought it would be a good opportunity to bring him in. We had also a meeting in Paris with the Banque de France. We had a third meeting in London with the head of ESG at the FCA, at the UK authority. And last but not least, we had also a meeting in Brussels with the European Commission's unit in charge of non-bank financial intermediaries. So just to illustrate the spectrum of our counterparts, just focusing here on the regulatory side. So this is really important to bring them the various buy-side views that we represent. In terms of topics, we have been working for the two last years at least on the review of the two cornerstones of legislation regarding funds in Europe, which are the UCITS directive and the IFM directive. And definitely, AMIC was very instrumental in making the review right. And we are still interacting with the European Commission and ESMA on the forthcoming level 2 implementing measures of that. And number 2, since before the consultation issued yesterday by the European Commission on NBFI, non-bank financial intermediaries, we already interacted with them, as I said. And I was very happy yesterday to see that in their consultation, they definitely already took on board some of our key points. But the story is not ending, and we still have to continue interacting in the near future with the Commission on non-bank financial intermediaries.
It's great to hear we're having impact even before the consultations come out, so that's it. We're being preemptive.
But for all that work, I should say that we are relying on 2 key persons in the secretariat of ICMA/AMIC, which are Nicolette Moser and Irene Ree, and without them, with a scarce a number of people at the staff of ICMA AMIC, we are doing a very, very good job, and so we are very grateful to them.
Excellent. Well, thank you very much for that. And obviously, I think the buy side is already a very important element of what we do. We want to continue to really reinforce and grow that as we look ahead. And I think your leadership, and alongside Max, and obviously with Nicolette and Irene from the staff, are well set to really push ahead in that area. Isabelle, coming to you, the principles are 10 years old now, another anniversary this year, and unquestionably the international standard in the area of sustainable finance. Can you give us an update, please, from the principles perspective?
Yes, good morning, everybody. So for those that aren't familiar, the principles has become the shorthand for what are the green bond principles, the social bond principles, the sustainability-linked bond principles, and the sustainability guidelines. And it's just a sort of shorthand way of looking at it. And I chair a committee of investors, issuers, and market underwriters. And then we've got a sort of wider ecosystem which has an advisory council that includes law firms and stock exchanges and others that are quite critical to the broad discussion on the sustainability markets. And we are equally very deftly guided by the Secretariat, by Nicolas Pfaff and Valérie Guillaumin, but also there's a lot of regulation in this area. And so, we've got Oscar and Simone, who've been utterly wonderful in helping us respond to the myriad of various bits of regulation that have been coming out. I think the main advantage of the way the committee works and the way the principles were established is this focus on transparency. So you can have regulations coming from all different sides of the world, new taxonomies, new ideas, different things to banish the possibility of greenwashing and other things. And the core of the principles is about transparency. What are the levels of transparency that we need to establish for people to be able to make decisions, and the buy side will be in a position to make decisions if they're getting the requisite information. And so a lot of what we're trying to do constantly is ensure that there is a good understanding of what is needed, what is robust, what is credible. I mean, there's no point asking for lots of things if the data isn't going to be credible or robust or able to be found. So we're always trying to make sure that we've got a good understanding as to what the level of information and data and robust data is that allows the market to function at its best. And I think that's how we can steer a course deftly between all this sort of walls of regulation. And we've continued to do that this year through a question and answer handbook, through impact reporting metric handbook, through new updates on sustainability-linked bond principles and the climate transition finance handbook. And we're continuing to work in this direction of helping the market understand what are the core transparency requirements that are needed to be able to operate in this space.
Thank you very much, and it's very clear that the influence really continues to grow, so long may that continue. Marc, I think, ICMA is synonymous with the primary market handbook and by definition also the PMPC, which is, I guess been the bedrock of primary market syndication practices, discipline and processes now for decades, which is great to see that we continue to have such a central role in the primary market activities. Can you give us an update from your perspective, please?
Sure. Good morning, everyone. I mean, as you say, Bryan, PMPC has been around, is the bedrock of ICMA, but that's partly because the primary markets are the bedrock of the bond markets. And I think we work together with all of the other committees here, and I think that's true amongst all of the committees. And really, one of the key benefits of ICMA as an organization is that we're not siloed looking at our own worlds, but we are sort of involving, whether it's the tech side, whether it's the principals, whether it's working with investors, whether it's secondary and repo, we all come together, and I think that builds a stronger and more resilient primary market from our side. PMPC brings together the syndicate heads from something like 70 firms across the European bond markets. So we are a sell-side organization, but we work very closely and try to engage as much as we can with the buy side. And we're focused on, as the name suggests, market practices. But we've been going for 40 years, and one would think that we're a mature market, and yet changes come every year, bigger changes come every other year. There's always new challenges to work together as an industry across, and it's, as we have with many of our committees here, it's a strange mix when you have firms that are naturally competing with each other coming together to work together, both for issuers on a day-to-day basis, but then at PMPC for the good of the market and the stability of the market. What have we been doing in the last 12 months? Well, I think is a good illustration of the types of things we deal with year in, year out. On the one hand, dealing with changing external factors, notably on the regulatory side. Jean-Luc highlighted it earlier. We've dealt with a very big change to how the regulatory process works in Asia, in particular in Hong Kong, with the SFC book building code. And thanks to the support of Mushtaq and Rory, I think the ABSF within the PMPC framework really worked amazingly well together and brought that to a successful primary conclusion. It's an ongoing process, but I think the initial year or so of working under that code's worked very, very well. Similarly, with the changes from the SEC and how they were calculating and enforcing Regulation M, that led to a little bit of an alarm call amongst PMPC in Europe in terms of how we as a European market can interact with SEC-registered issuance. And again, thanks to Paul Richards and to Rory Ewing, the PMPC were able to get to a good position on that and work through. And these are small examples, but they're examples of things that happen year in, year out, and I think we couldn't do it without the support of ICMA, both as an organization, but in particular as a secretariat, and I think we'll miss Paul, and we're very reliant on Rory Ewing.
Great, thanks. I think, as you say, a lot of the work is quite, technical and documentation-driven and specific in its nature, but hugely important on the broad health of the capital markets more broadly. You can't have liquidity in a secondary market without an effective and healthy primary market. So I think these are very important initiatives that we take on a consistent basis through the PMPC. Thank you. So Emma, finally coming to you, and welcome as our newest co-chair. Also, I guess FINAC is the newest committee that we have formed just in January 2020. So, really interested to hear your views on how things have evolved. Obviously, I think it's a committee that has the potential and the propensity to have the most impact going forward because of the nature and speed of change that we're seeing in digitalization and technology. But maybe firstly, just a little bit of a look back, if you have that information at hand to tell us what the committee's been up to over the last year.
Yeah, of course. Thank you very much. So, new face up here. My name is Emma Lovett, and I'm co-chair of the Fintech Advisory Committee, alongside Justin Chan from BlackRock, who can't be here today. But I think it's a new, a slightly new phase for the committee because we'll have a co-chair, one representation from the sell side, which is myself, and then Justin from the buy side. I did just want to use this platform quickly to say thank you very much to Armin Peter, who has been chair of the committee for several years and has really made great strides in terms of what we've achieved. And so when I do the look back, you know, it's all thanks to Armin chairing the committee from that side. So the committee meets quarterly. We don't work on any necessarily any single initiative. I think that's that would be quite difficult with the mandate of the committee. But we look at what DLT and AI means for the capital markets, promoting open and common standards with also consideration to ESG. Our key areas of priorities are expand geographical reach, digital bonds, the adoption of models and standards, advocacy, and events and education. In terms of some of the milestones that we've achieved this year, we have a subcommittee, the DLT Bonds Working Group, which is chaired by Christoph, who I saw earlier today, Christoph Hock from Union Invest. And as Janice Wilkinson mentioned in her introductory welcome, really quite a key milestone this year was the issuance of the HKMA digital green bond, which used the digital bond taxonomy put together by ICMA. So I think that this is sort of like one of the firsts of, you know, how this committee can sort of start to, you know, have common standards across the market, particularly in such a nascent sort of area.
Thanks. Exciting times, I think, looking ahead. But as you rightly say, we're hugely indebted to Armin for everything that he's done to really put a lot of energy and substance into the FinAct. So, you know, I think we've really benefited from his incredible involvement, but we're in very safe hands also. Looking ahead. So maybe I'll move now to second question. And again, if we can just keep it to 2 or 3 minutes each. And I think more looking ahead now, you know, we've talked a lot about the regulatory agenda, the geopolitics, some of the other issues around the macroeconomic situation as well. But what would you perceive or see to be, you know, the major challenge or challenges for that matter that the committee might have to address as we look ahead? Gareth, I'll come back to you again.
Yeah, sure. So we talk about geopolitics. I think this is definitely one of the big major challenges, right? So repo and collateral, it's predominantly a credit risk mitigant, right? You know, we use it to mitigate all sorts of risk, and we're also at the confluence of credit risk, market risk, liquidity risk, settlement risk, operational risk. You know, there's lots of stuff going on, and I guess with the geopolitical environment at the moment, you know, repo desks everywhere are always trying to anticipate what the next thing might be. You know, running fire drills on their books across the different potential risks. You know, the other thing is around specific country risks. You know, that can be one. We've seen kind of events, you know, whether it's the Middle East or within Europe. And then also idiosyncratic risks as well. You know, the events of last year with respect to the banking crisis, the US banking crisis. You know, and I was very close to the events in Switzerland last year, and it's just kind of a wake-up call and reminds you of, you know, what could happen very, very quickly in the markets. So, you know, so these are one of the major challenges. That, I guess, aside from that, you've got the kind of, we've already mentioned some of the regulatory changes, the potential move to T+1, especially within a European landscape, pushing repo into T0. So this really changes, completely would change the way that we have to think about managing day-to-day liquidity, around managing settlement, intraday liquidity as well. So 80 to 90% of the repo book rolls every single day, which means, you know, your transactions are netted. You know, reverse repos become the next reverse repos. So if you bring this into the T0, then it suddenly creates a huge intraday liquidity challenge. I think combined as well with the fragmented infrastructure across Europe. You know, this is, kind of compounds the issue. So this is all stuff to work through over the next few, you know, months to years.
Yeah, it sounds like it could be busy times, and I think, David, a lot of those points may be relevant in the context of the cash markets as well. Would you like to give your perspective on things we'll need to be focused on in the next year or so?
Yeah, very relevant, and I would echo particularly the fragmentation point and fragmentation of regulations that seems to be increasing. I would also like to echo Commissioner McGuinness' points from yesterday about CMU, and even take it a step forward and say that CMU is great for Europe, but it has to be also for global markets in a way. I land the idea of fragmentation in examples, right? We're going T+1 in the US and not in Europe, and we have a lot of clients asking, what do we do when we trade a US bond in Europe? Are you flexible, are you not? We're going to have 2 consolidated tapes plus trays. How do you aggregate all that together? Does it make sense to have 2 different deferrals? And this is just a list, but it goes on and on. It's becoming very, very costly to implement all these regulations. I mean, Brexit is something that people have almost forgotten. And we have teams of hundreds and hundreds of people working still in Brexit projects. Regulations don't go away, and when they're done in a complex way, they tend to be extremely painful. Now, this is where I see our committees working together and ICMA as a connector and as a glue in the industry. And it actually helps a lot to connect pension fund in Canada with an investment in Nigeria. That's the only way. Like, capital markets are global. And I think our committee helps with those things. We try every time to have a global approach to things. And we will have more of that this year, designing a transparency regime. It's been an interesting year. Next year will be even more challenging with this different fragmentation, but I think we'll get there.
Thanks. Stéphane, we've touched on the kind of the regulatory imperative, and that's coming our way, specifically impacting on the buy side. Is there, in addition to that, but obviously, looking at that specifically, are there a lot of things that you would highlight?
Well, at least for this year and for the next 1 or 2, or more than 1 or 2 years for some topics. So in the short term, we still have to prepare and to work hardly on the implementing measures of AIFMD and UCITS directives, because if the details which are going to be issued by ESMA and then adopted by the Commission on AIFMD and UCITS do not work in the next few years, it will be really damaging for asset managers, but also for end investors. So we have really to work hard on this key topic for the next few years. The other topic that I touched upon briefly right before is on the so-called non-bank financial intermediaries, or intermediation. It's a global topic, which was raised several years ago already, in particular by the Financial Stability Board, FSB, and complemented by IOSCO, and now it's coming in the EU at the level of the European Commission, issuing a consultation yesterday on that. On that second topic, so of NBFI, our message that I make is clear. We should make a difference, and policymakers should make a clear difference between those non-banks which are already regulated as compared to non-banks which are not regulated at all. This is a key message, because even if non-banks could be more regulated or be subject to additional regulations, they are already known by regulators, known by supervisors, and so their activities are in the light, if not in the spotlight, but under the spotlight. While the rest of NBFIs, those which are not regulated, like the so-called case of Archegos a few years ago, this is where the danger lies, because no one knows precisely what they are. So this is a key message we have to convey through AMIC to the European Commission in the short term and more here in the EU, but also more widely to make that clear distinction. This is really critical. On geopolitics, one point, apart from regulation, I think definitely the defense issue will become potentially a critical game changer for financial market participants, because there is a growing pressure both in the UK and in the EU to facilitate the financing of the defense industry by the financial participants. Will it be on a voluntary basis? Will it be on a more compulsory basis or under pressure by policymakers? Will it have, therefore, some impact on our activities, both, by the way, sell side and buy side, whatever? It is really a key question mark to anticipate for an answer and to adjust on that potential game changer in our activities. And on that specific topic, an underlying aspect is on ESG investment. Should, for instance, the industry, weapon industry be eligible in a wide way for as being considered as ESG investments or not? I think the defense issue is growing progressively interacting with our activities, and it must be clearly identified and tackled upon.
I think definitely we can play a significant role ourselves in helping, some of this kind of, let's call it mapping or a deeper understanding of, what actually sits in the buy side. As you say, there's such a plethora of different kinds of institutions that play different roles, but, clearly it's the case that a lot of these new entrants are taking up bigger roles in terms of their participation in wholesale markets. But, whether it's ourselves or the industry itself or the regulators, I think the transparency is still, very minimal. So I think really identifying how these operators work and working together, obviously with the AMIC and other constituent parts, and bringing that together from the ICMA perspective will be a very important exercise that we need to carry out this year. Isabelle, your thoughts?
Yes, I was just
greenwashing, maybe?
I was just enjoying that point, because I think it speaks to a lot of what we constantly are grappling with in the principles, which is, lots of things have two sides to the coin, like the weapons point part. And we certainly saw an attempt by the EU to look at a social taxonomy where they wanted to rule out things, including weapons. And, you have to differentiate between things. And I think that's a lot of what we're constantly trying to grapple with, is the positives and negatives, and how to holistically look at things, and how to ensure that you're not ruling out things that are important, how to highlight things that are of critical importance. So I suppose for us, one of the challenges is that in order for us to meet the goals of the Paris Agreement collectively, globally, we actually need to ensure that high emitters are able to transform their businesses. And we have to get them in to doing things that are meaningful, and not find that we're going to be somehow accused of greenwashing. And there's also the idea that you can have somehow the marvels of electric cars with lithium batteries, or wind farms with steel, or other things, without having the mining or without having the messy bits of it. So how do we ensure that we look at things in a holistic way, so that we don't have any sort of move to say, yes, we want the good bits, but we don't want the absolutely critical enabling things that we need to depend on. So I think trying to ensure constantly that we're thinking about things and advocating for things in a holistic way, so we can achieve the goals that we need, both environmental and social, without in any way opening oneself up to easy greenwashing charges, without thinking in a sort of reflexive way that happens sometimes. Isn't that greenwashing? Well, how do you get there otherwise? So trying to think about how to frame it in such a way that it is robust, that it is tied in, that it is done in a way that can really remove those greenwashing charges. So I think that's really quite critical for us.
And I think we'll hear a little bit more on some of these guidance themes, maybe on enabling from the principles AGM upcoming, yeah?
Absolutely, absolutely.
Marc, over to you.
Sure. I mean, on our side, I think the main thing we're expecting in the next 12 months is the thing we've been experiencing in the last 12 months, which is just incredibly busy, incredibly active across markets. And despite there being a huge amount of geopolitical activity, change in terms of how the world looks at ESG, a very clear changing environment in terms of inflation and in direction of interest rates, the market plows on with incredible activity. And I think that's why it's critical, I think, in terms of the buy-side engagement process that we've really been ramping up in the last year or so, to work together with our partners on the buy side as to how we can keep the new issue process as efficient as possible. Because it's, in many ways, we've changed with the times. In other ways, we're still fundamentally the same sort of dinosaur hat-wearing process that we were in the 80s or 90s. And that's a burden for syndicate desks, it's a burden for issuers, and especially it's a burden for investors who are dealing with, I think last week we had the record number of issuances in the European market of all time. And those all have to be dealt with by the same number of portfolio managers, the same number of analysts. So I think that's one of the critical areas. Equally, the knock-on impacts of T+1, as we start to get issuers pushing maybe more of the T+5 trades to T+3 and asking the question about whether we can do primary trades in T+2. And then I think linked to the previous point, just working our way through adaptation to technology. And I think we're going to be working increasingly closely with our fintech partners and with the technology committee at ICMA, because the way we can make ourselves more efficient, the way we can help the buy side, is to increasingly integrate tech into the primary process.
I mean, maybe more with your JP Morgan hat on rather than your ICMA hat, but you know, the first few months of this year have been phenomenally strong, right, in terms of volumes and credit spreads. But I think, you know, the outlook is still for high volumes, you know, especially with some of the government intentions to boost their funding programs. You've got QT, obviously, at the same time. Does it keep you awake at night, you know, that the second half of the year we could be building up to a pending car crash in terms of, you know, a freeze in market activity, or are we not at that point?
Yeah, the amazing thing is how robust, it's true on the secondary side, how there have been so many events in the last year, but the last 5 years, which theoretically could have been the cause of a car crash, could have been something that we could all lose sleep over, but the market, broadly defined, and I think arguably it's the buy side, have taken in their stride. We obviously had plenty of support during the pandemic and afterwards from the public sector in terms of buying programs. As that's been wound down, the investor community, buoyed by, I guess, higher rates, higher carry available on fixed income product, has been there very much to keep things going. Personally, I feel very comfortable with, famous last words, with the second half of the year, because I think we've seen the frequent issuers, whether on the public sector side, the financial side, or the corporate side, take advantage of buoyant markets, lock in liquidity. So the market could handle a period of volatility, which often means we don't get the period of volatility because people know the market can handle the period of volatility. We're obviously going into, we've been in a busy election year. We're going to experience more of that in the UK in a few weeks' time, and then obviously the US in Q4, and that's something that the market is watching, but it doesn't feel like it's getting in the way either on the buy side or the sell side or on the issuer side.
Thanks a lot. Emma, over to you.
So I guess at a very high level, we're dealing with innovative technology, which brings challenges every single day. I think some of them will be addressed even in the next panel. So I'm just going to sort of like do a quick future look as to what, as a committee, we're looking to do on the AI side, because that is something that we've been monitoring, but this year we are looking to actually define a strategy that's likely to focus on education, networking, and showing best practice. So I'll be quick.
Can I ask you, you know, we see a lot of experimentation and pilots on the DLT usage in the capital markets, but still it seems to be that, you know, we haven't really got to a point yet that anything's really scalable. and I think the cash leg continues to be, present questions, and I think, the market participants will generally vary, but, they could put a 3-year time horizon on things been scalable, or some would put a 10-year time horizon on things been scalable. I mean, we're doing a lot of work in this space, and, you don't have a crystal ball, but just wondering whether you've got a perspective on, what we can expect to see in terms of, DLT becoming more embedded in market activities.
It's true that at the moment, these bonds are issued on an initiative by initiative basis. We don't really have an off-the-shelf product for them yet. And part of that is to do with the technology, and I think that we're at sort of like one stage of evolution that's been completed. We've moved from proof of concept into production, but the production trades have all been quite small, apart from the HKMA one, of course, earlier in the year. And that sort of moved us into this sort of phase of what we're calling interoperability within the industry, which is making sure that these platforms can talk to each other so that investors can freely buy bonds just sort of across the industry when they're issued onto these platforms. And then the second part is sort of like the legal and regulatory work that is still to be done sort of jurisdiction by jurisdiction. So there's sort of two main components that we're working towards in the industry, but it's just taking time. It's quite difficult to put a timeline on it, and I know if I say something, I'll be called up again and asked why it has or hasn't happened. I do think that it's looking more short-term now than it was 18 months ago, 2 years ago, and the trajectory, for example, in digital bonds, we've seen many more this year than we saw last year, and we do expect that trajectory to continue. So I think it's more of a watch this space rather than putting our flag in the sand and saying, by the end of 2027, this is what the landscape's going to look like.
Okay, great. Well, I think we've almost out of time, and rather than move on to another question, maybe we can just kind of keep the timely approach that we've been able to adopt this morning, so we're all ready for the conference at 1 o'clock. So I think I'd really like to thank all of you for your great support of ICMA on a consistent basis, but also the great work that we're doing through your committees to really help to advance market standards, but also the engagement with the regulators. So I'd like to thank our panelists for their great comments and also their ongoing support.